You swipe a credit card for groceries. $40. Nothing dramatic. Milk, bread, eggs. You tell yourself something simple. I'll pay it back when my paycheck arrives. And for a moment, the system works. But what almost no one realizes is that this exact moment, this tiny swipe for basic survival, is where one of the most expensive financial traps in modern life begins. Not when you buy a luxury watch, not when you finance a vacation, when you buy groceries with a high-interest credit card. Because when everyday living starts running on borrowed money, the math quietly turns against you, and it does it faster than most people think. Right now, millions of people are doing exactly this. Rent, gas, food, utilities, not because they're reckless, because their income stopped stretching far enough. Inflation rises, paychecks lag behind, so people fill the gap with credit. At first, it feels harmless. A few $100s this month, maybe $600 next month. But here's where the system reveals its real design. Credit cards were never built to help people carry everyday expenses. They were built to make money from people who do. And the key is a number most people glance at once, then ignore forever. APR, annual percentage rate. Today, many credit cards charge 20 to 30% interest. That sounds abstract, but let's translate that into something real. Imagine you put $1,000 of normal living expenses on a credit card. Groceries, gas, bills. Nothing extravagant, just life. If the interest rate is 25%, that means the bank is charging roughly 2% interest every month. 2% doesn't sound scary until you realize something important. Credit cards don't just charge interest, they compound it, which means if you carry that balance, interest starts charging interest month after month, quietly, slowly, relentlessly. Now here's the twist most people don't see coming. Credit cards only require a minimum payment, usually around 2 to 3% of the balance, which feels manageable. Your statement arrives. Minimum payment, $30. Easy. You pay it. Problem solved. Except it isn't, because that $30 mostly goes toward interest, not the debt, so the balance barely moves. Let's follow the math for a moment. You owe $1,000 at 25% APR. You make the minimum payments. It can take over 10 years to pay it off. And by the time you're done, you may have paid another $1,000 or more in interest for groceries that were eaten years ago, milk that expired in 2024, bread you forgot about, food that literally disappeared, but the debt stayed. And this is where the system gets quietly absurd. Credit cards were originally designed as short-term borrowing tools. Pay now, pay it off in a month, no interest. Simple. But once balances carry over month to month, the card transforms into something else entirely. A very expensive loan with some of the highest consumer interest rates in the financial system. Higher than car loans, higher than mortgages, sometimes even higher than personal loans. And yet millions of people unknowingly use them as a replacement for income, which creates a strange financial illusion. Your lifestyle doesn't change, groceries still appear, gas still fills the tank, bills still get paid, so everything feels stable. But under the surface, something different is happening. Every month, your future income is being spent in advance, which slowly compresses your financial breathing room. Because next month arrives, but part of your paycheck already belongs to last month's groceries, so you swipe again, not because you want to, because now you need to. And this is where the spiral begins. Debt leads to interest. Interest leads to higher balances. Higher balances require higher minimum payments. Higher payments eat more of your income, which forces more credit use. The system loops, quietly, efficiently, almost invisibly. Banks even have a name for customers who fall into this pattern. They call them revolvers, people who carry balances month after month. And from a business perspective, revolvers are extremely valuable because every swipe becomes a small stream of interest flowing back to the lender, month after month, year after year. Now here's the uncomfortable truth. The credit card industry doesn't actually make most of its money from people who pay their cards off every month. Those people are called transactors. They use the card, but they never carry debt, which means the bank earns very little interest from them. The real profits come from the other group, people using credit to survive normal life. Groceries, rent gaps, gas, emergencies. The system works because those balances rarely disappear quickly. They linger. Lingering debt is profitable. This doesn't mean credit cards are evil. In fact, used correctly, they can be powerful tools: fraud protection, rewards, short-term liquidity. The moment credit cards start replacing income instead of bridging timing gaps, the economics flip fast. Because unlike wages, interest compounds, and compound interest has no sympathy for inflation, no patience for tight budgets, and absolutely no sense of mercy. It just keeps calculating every day, which leads to a strange modern reality. Many people feel like they're financially running in place, working, paying bills, staying afloat, but never moving forward, because a portion of their income is quietly flowing backward into past purchases that are already gone. And that raises a bigger question most people never stop to ask. If millions of households now rely on high-interest credit just to maintain normal living, what happens when interest rates rise even higher, or when an unexpected expense appears, or when the minimum payments finally become too large to ignore? Because at some point, the math catches up. It always does. The real question is not whether the credit card system works. Clearly it does. The real question is this: what happens to an economy when everyday survival starts running on 25% interest?